Hey, how's everybody doing? John Napolitano here with you with Top Trading Pro. I hope everybody's doing well today. A topic that came up this week that's very interesting and something that actually hasn't happened in a while is volatility. We see volatility coming back into the markets. So basically, the purpose of this video is to discuss how options traders handle volatility when it rises, when it kind of comes out of nowhere. And what's interesting about this volatility is you have to ask yourself the question, is it kind of here to stay, or is it something that is going to kind of pass over? That is the question. So the way I trade, which some of my students are aware of, I do something called basket trading. What that basically does is it allows me to be flexible when a new environment or a new catalyst or something new enters the market. This week, we had volatility come into the market. Why is volatility so important? Well, if you're trading options, it has to be at the forefront of everything you do. As you know, as some of you know, with options, you have four basic choices instead of two. In the stock market, you have two choices. You could either go long or go short. With options, you could either buy a call, sell a call, buy a put, or sell a put. And out of all those four choices, that's the building blocks of all the strategies and options that you're going to learn. The main difference between buying an option and selling an option is, are you a debit trader or are you a credit trader? It doesn't even matter whether you're bearish or bullish. Obviously, those are the second choices you have to make, whether you're bearish or bullish on a stock. However, when you are trading options, one of the biggest mistakes I see people make is that they just buy calls and puts. And that works in a low volatility environment. It does not work when you have a choppy environment, which we've been in for the last couple of weeks, as well as a high volatility environment, which we might be entering in the next couple of days to weeks. So these are the things you have to learn as an options trader. I teach this class called the Boot Camp. It's a 14-day introduction to options as well as option strategies with top trading pros. We cover all these strategies in our boot camp classes, so you'd become a little bit of an expert at what to do and when, and that's really the key to successful options trading. So I'm just going to share my screen with you here. Bear with me one second. I'm going to show you exactly what volatility looks like, and I'm going to show you what actually could happen if you're not careful. So let me just show you what the volatility looks like here. Basically, as you can see, this is just the 1 month VIX futures contracts here that I'm showing you guys. And as you can see, it's well off its lows. We had a 3-day spike and it's coming off a little bit here. So now it's going to test these moving averages and see if it's actually going to go higher into this 200-day moving average. So it's kind of a wait and see to see what's going to happen. But you have to be very, very aware of what the VIX is doing when you're trading options, when you're deciding on what strategy to use. And the reason why is because when you're buying an option, the price of that option that you buy is based on two main factors. Factor number one is obviously the underlying asset price, whether it's an in the money or an out of the money option and everything else. So obviously the movement of the actual stock price itself has to do with the price of the option that you're buying. That being said, the second main factor, which a lot of people overlook, is volatility. If volatility of the stock or the overall market increases, now this doesn't matter whether you're buying a put or a call. It matters. What matters is how the volatility is moving. If volatility increases, the price of that option that you're buying is going to be higher. Now, when you overpay for something, that's never good. Okay. And that's the biggest mistake I see new option traders make. They see an opportunity in the market, they see a stock that they like, or they see a stock that they want to go short, and they buy calls and puts, and they don't really understand what they're paying. They don't realize that what's in the price of that actual contract that they're paying is implied volatility. If volatility goes up, you are overpaying. So that helps you decide whether you should be a debit trader or a credit trader. Remember, there's four choices with options. So basically, when you have a situation like this, you have to start thinking of strategies that work well environments of possible rising volatility. Now we're in an environment right now where volatility isn't super hyper, we're not in freak out mode, in other words, but we are starting to see elevated volatility. Now, if this volatility goes over, let's say you go ahead and you buy that call option, and let's say, for instance, volatility subsides. One thing that's interesting about volatility, and I'm going to show you this, I'm going to move out a little bit and show you a little bit more here. If you'll notice, volatility does not tend to, based on this chart here, volatility does not tend to last very long. You'll get a spike and then it'll kind of die down, then it'll pop up again, and then it'll get complacent again, and then it'll die down, and then it'll jump up again. So when that happens, that is how you get caught up in bad trades. If you buy a call option, let's say up here when vol is high, if volatility continues to go higher and your stock continues to go higher, that could potentially be a profitable trade. But what could also happen is volatility could contract on you. If volatility contracts on you, what's going to happen is you overpaid for your option. And even if here's the nasty thing about this, even if the stock itself goes up, even if what you're doing actually happens, let's say you buy an Apple call option and Apple goes up. If you bought it in a high volatility environment where volatility is going down, you might lose money. You might lose all your option, basically, because what happens is the rise in the stock price did not keep up with the deflation and volatility. I've seen that happen too. I've seen new option traders scratch their heads like, what the heck just happened? They don't understand volatility. So please, if these are things that you want to learn, you have to learn them the right way. They're not difficult to learn. They're not difficult to master. With volatility, there are just a couple simple rules you have to follow. I have a step-by-step approach that I teach my students: when to be a debit trader, when to be a credit trader, when to be a spread trader, when to buy straight calls, and when to buy straight puts. Picking the best option strategy is probably one of the most underserved, one of the most more challenging things you have to learn, and to learn it the right way is very important. It's not difficult. You just got to follow some simple rules. Okay. So I hope this was helpful. Again, if you want to learn more about this stuff, spend some time in our boot camp. Go to toptradingpros.com, click on my link, and you could attend my next boot camp. Other than that, we're going to keep producing videos like this to try to educate people. Follow us on YouTube, also toptradingpros.com. And hopefully you'll get some education. You'll be able to be successful at this stuff. And please enjoy the rest of your day. Stay safe, and I will talk to you guys soon. Okay, take care, everybody.